Well, good evening. Welcome to Laredo Integrity Financial channel. Today, we have a very, very crazy day. This is the first time we have Ryan from Integrity slash Alliance. This is the first time we have someone actually from corporate here visiting in Laredo. So today, today we have a lot of questions. Ryan is a financial advisor from our company. So today we're gonna learn a lot from him. We're gonna pick up on his brain. We're kind of like, I want to say, get a lot of information from him and learn as well, right? So today, Ryan, thank you for being here and tell us a little bit more about you.
Yeah, thank you so much for having me. And first time in Laredo, and I definitely will be back because there's great people here. Obviously love Mexican food. There's great Mexican food down here for sure. Let's make sure we shout out on the food here. But yeah, so I've been in financial services for 11 years now. Started with a big nationwide firm. Was there for about 10 years. Came into the Alliance about 3 years ago. And really just coming from, when working with, one carrier and a few products to now we have, 40 to 50 carriers and multiple hundreds of products and different programs that we can help family across the nation with different types of planning needs. Anything from, insurance questions to Medicare to retirement, investments, estate planning, trust and will, debt solution, tax mitigation strategies, and more. So definitely I'm really excited for the opportunity and truly the mission and the passion is to help as many family as possible to be financially literate and to give them more education on day-to-day financial planning.
Perfect. Also, we wanna thank Ryan also, but we also want to thank Karen from Karen Insurance. She is actually local. We're on the same office, but she is a celebrity as well in Laredo. So thank you for being here today, Karen.
Thank you.
So tell us a little bit about yourself. Like, who is Karen in Laredo?
I have been in business for 6 years now, and I'm like very grateful because I have the opportunity to help the Laredo community and all the life insurance with the ACA. I work with the senior market also, with helping with the Medicare Advantage supplement, and what else?
Everything.
Everything.
I think pretty much everyone that knows Karen knows that she's everywhere. Like, you see boards out there, you see everything.
Yep.
Karen is events.
Yeah, very
Everybody.
involved in the community, and I like to help with the nonprofit causes, and
Everything that it's voluntary and all that stuff. It's I think Karen does a really really good job on that. And myself also, like, we also have Gilbert from JL Marketing and the studio as well. We're in the studio of After Hours. So today, what are we going to do today here is very important, not only to help out people, but also is very important to people to know what are their options when it comes to being helped, and also like for them to have a better understanding of what we do. Today we're going to touch a lot of bases on financials, right? The reason why is because we have Ryan, and we wanna take advantage of the opportunity that he's going to explain us a little bit more about what it is, not only life, what is annuities, what is an IUL, what are the options out there for everyone, not only for younger people, also for senior citizens and everything else, right? So we're going to start I want to say very basic. What does life insurance can do for us, pretty much? Can you kind of like deep dive onto life insurance?
Yeah, so when I look at life insurance in general, if you look at overall planning, and I describe it as such as like building a house, right? So when you build a house, you really start with the foundation first, like in the blueprint, and then there's the structure of the home, and then the final stage is the roof, right? So in the foundation piece of financial planning, life insurance belongs in the foundation. So the risk management part, that's what we first looked at when you look at clients planning, emergency fund, health insurance, their Medicares, or anything that they definitely need to take the risk off the table. And essentially with life insurance, really the basic knowledge of most people is, hey, if I get a life insurance policy and God forbid something happened and I'm no longer here, my beneficiary, they will be taken care of by a form of a tax-free lump sum check by the insurance carrier, right? So that's what most people understand what life insurance is. It's a form of a leverage, is a form of a protection. Now, a lot of people, what I think in the past 11 years, what I find is, although they know that life insurance exists, but the biggest problem in the United States is over 50% of the people say they don't have it. And more people say they have something, but they feel like they're completely, just really utterly underinsured. So that's the problem, right, in America. So with life insurance, in the ways, like what we want to do is first figure out, of course, do you have the need? Like, what is actually the need? What needs to be covered and who needs to be protected, right? And usually it might be a loved one, or it might be a children. You're trying to make sure that if they're younger, they have enough money to go to school. If God forbid there is still a mortgage payment to be there, you don't want to leave your spouse and your children kind of, have to basically their home being taken away from the banks and go back to grandma's house to live in the basement or go back to an apartment, right? So we're trying to find the needs and calculate the client's needs. And most of the time, I would say when I meet with the clients, I say, hey, if life insurance could be done and you could implement that strategy, like what are some of the things you want to help protect? The first thing they would say is, well, I have a mortgage, right?
Yes.
So we will calculate how much total mortgage is left on the property. Number two will be essentially the final expense, right? Would you rather your wife's family come up with the money to bury you, or would you want to have something that's you have in place that can cover the final expense?
Yes.
So that's number two. Number three will be debt. So most people have credit cards, most people have car loans, student loans perhaps. Do you want your spouse to be debt free, right? So we'll look at the total debt. That's number three. And number four is education. So God forbid something happened to you, do you still want your children to be able to go to school, right? Or at least have the opportunity to go to school. They don't have to go to college, but at least can we get something aside? So if they do decide to pursue higher education, they're not like have to take out a hefty student loan, which is a terrible idea, right?
Yes.
So finally, the fifth most important one is income replacement. So let's say a father is making $100,000 a year and their youngest children is only 5 years old. I'm like, well, your youngest is 5, it's 13 more years until your kids turn 18 as an adult. So if you make $100,000 a year, assuming you never get another raise ever again, $100,000 a year salary times 13 years is already $1.3 million. With all that stuff add up, the number gets crazy. And you say, hey, I add everything up. Technically, God forbid, if you are no longer here today, your family will just be okay with the life insurance of, call it $2 million. And they're like, oh my God. Like, I'll say, what do you think about that number? And the answer is always, that's a very large number. That's very high. And I go, so based off the math and everything we put together, which part should we take away? And the answer is always the same, I guess none, right? Because we literally calculated everything. So we'll say, well, the good news is, even though you have a $2 million need, one, you need to understand how valuable you are to your family, right? Mm-hmm. People will spend $100, $200, $300 a month to protect a truck, which as soon as they drive off the lot, they lose half the value. People will spend thousands of dollars a year on home insurance, which they're not guaranteed to use. And of course, health insurance, that's another crazy story about how much health insurance costs for a family. So as well, with all that being said, like, what is the most valuable asset you have? It's technically you, right? You are the ATM, like you are the cash cow. If you stay alive and continue to work, you're gonna be worth a lot of money, assuming you never even get a raise. But who are we kidding, right? Yes. You're gonna get a raise. So the good news is, for a $2 million need, we can use term life insurance, which is temporary, right? It's extremely affordable. Mm-hmm. Let's say a 40-year-old male getting a $2 million insurance policy is probably gonna cost them maybe $100 a month, right? Or maybe a little over $100, assuming they're healthy, which is crazy, right? So, and also there's permanent insurance. So depending on the budget, like, hey, at some point, right, do you want to have some protection that's not just temporary, that will expire, that's going to be there, that's going to be permanent, that's going to be payout no matter what? Because at the end of the day, we know, life insurance is truly, truly the only one insurance that people are guaranteed to use in their lifetime. Because last time we checked, no one lived forever. Somebody tried in the past. There is an emperor back in China thousands of years ago. He was trying to live forever. So he sent all the missionary, all his best people out to look for a magic herbs that would help them live forever. And guess what? Those people, they left and then they never come back. They went to Japan, they went to Korea. They said, hey, we found a nice land. Let's just stay. And then eventually the empire died, right? So even though he tried, but no one lived forever. So life insurance, one of those things is, yes, we don't want to talk about unforeseen future death, but it's a very important foundation in financial planning. You need to talk to a professional, not just kind of give you a sum amount. Oh, you should get 100,000. You should get a 500,000. You should get 1.2 million. Well, my question is, why and how did you get to that math? How did they walk you through the needs?
Yeah.
So that's what we do when it comes to life insurance planning.
Yeah, and that's a big topic that we usually talk about a lot of the times. Like, what is the importance of the life insurance, and what insurance do I get? Right? There's plenty of them to choose. Me and him, we were talking about like what is the best thing to do when it comes to insurance. Okay, yeah, you can start with term, but then eventually you want something permanent. Term, the actual term word says it all, is just temporary, right? So then the good thing that you also mentioned is like when you have a mortgage, a lot of people believe that actually when someone passes away and you're still paying the house, automatically the property goes into their family, and it doesn't, right? So that's something to look at too. Like, and we have other like products that we sell as well that we're gonna go in deep after, but the decisions that you take prior to things happening, that's going to make the difference. That's what we talk a lot about that. In us as agents, I think that's our job to make sure that everything happens the right way, right? Any questions that you have about the insurance?
Not questions, but I do want to add that I guess I don't want. No, never mind. Since I do want to say I'm like the youngest from this group.
I don't know what that's supposed to mean.
No, I
sure.
I just pretty much want to say that most people my age don't even know what life insurance is. Like,
Maybe they know.
Like,
the thing is, they don't see the importance to have
the need.
it.
Exactly.
Because they don't have, like you mentioned it yesterday.
Yep.
They don't have kids. They don't have.
Pretty much.
They are not paying like mortgage or something.
Yeah.
So it's not important.
No spouse.
Yeah. So those are two key points that I pretty much want to bring up when it comes to life insurance. That pretty much young people, we aren't like educated enough about life insurance. And whenever you do bring it up, they're like, oh, no, we're really young, so why do I need it? But also not knowing that there's, like, I guess you could say products that also benefit them, like, not just after, but, like, during their, like, lifetime and stuff.
Yeah.
Or, for example, like, the products with Mutual of Omaha that, they don't have it anymore, but they have products that have ROP, so return of premium.
Mm-hmm.
So in a way, it's like
kind of saving.
a little bit of a savings for them.
Yeah.
And they're also protected. So
Yeah.
And also, like, we're gonna get into the IULs as well, which is that's something that I want Ryan to explain very well, because it's very important.
Yeah.
Right. But also, like, I want to touch bases also, like, on the health insurance, right? Because that's something Karen is really big on, especially with Medicare, but health insurance as it is, right? How the health insurance is important for basic financials is practically the benefits or not paying the whole amount, right? And I want Karen to kind of like touch bases on it, because that's what she specializes on. But in reality is, what can you tell us about the importance of health insurance and also like Medicare right now?
Well, about the health insurance, I think we need to have the protection because we don't know when we are going to get sick or have an accident. Sometimes I have most of my clients say, "Oh, I'm healthy." Yeah, but you are like maybe you will have an accident. I don't know. Are you driving? Are you driving? Yes. Okay. You maybe got an accident and you go to the hospital and you will have like without insurance maybe you will get a bill for 100,000 without insurance. If you have insurance, I think the most because most of the plan the max out of pocket is 10,000 and it's easier to pay 10,000 instead of pay 100,000. That's why it's important. Even though you are healthy, you maybe get any I don't know infection or anything.
Something viral.
We didn't know, like we don't know what is gonna happen. So
Yeah.
it's some of the things that all of us need to have the health insurance.
Yeah, because
actually.
especially here on the border, a lot of people have that idea that you know what, I get sick, I go across, and it's
Yeah.
cheaper, right?
But the
It's not-
emergency, the
yeah,
thing is for the emergency, if you're healthy, it's okay. But what happened in an accident?
and it's not the same. Actually, whenever we have that, it's not only just for emergencies. Like, we get the picture that nowadays diseases are a little bit more aggressive than before. So once you get a little like flu, you don't get a flu like before. Nowadays, it's a little bit more, I want to say, aggressive towards like the body of the people. It depends on the people, right? But also like I want to say that sometimes you don't have access to the medication just right out over the counter. Sometimes it's like, hey, you know what? It's a little bit more aggressive that you need to go to the doctor. I rather pay $30 or $25
The
of
copay.
the copay instead of just going and pay, I don't know, $1,000 or going to the emergency room. How much is the emergency room right now? The emergency room is about $3,000, $4,000 just to go in, right, as an emergency. So health insurance is very important in that sense, and also it's very important for financials, right, because it saves you a lot of time. When life insurance, I believe, makes you have a little like a peace of mind. Also, health insurance it goes hand in hand for me. The reason why is because at the end of the day, it's saving you money,
Yes.
right? So, and then we can touch bases also in Medicare, right? But that's a different topic when it comes to 65 years old and people that are already retired. But you want to touch bases on that as well? How can you how does Medicare work for people? I don't know if you want to explain
Well,
the timelines.
in my experience, I think Medicare. Most of the people that turning 65, they are confused. They are most of the time they are confused. They don't know. Okay, I'm turning 65 now. What? I think we need like put the information out there so they have more resources to know or understand. Okay, I'm turning 65 now. I have to do this, this, and this. It's our job, like an agent, as an agent, to put the information out there so help them to understand what are the steps when you turn in 65. And I always have clients that say, "Oh, I'm turning 65. I'm so confused. I'm so stressed." Okay, that's my job. You just sit down. I'm gonna do this the very simple way so you don't worry about. Because if you don't enroll in your initial enrollment, you will get penalty and all that. So it's important to know all the timing and all that. No?
Exactly.
So we're trying to that's the thing that we wanted to have more events that we can get people there so we can educate them. It's
Yeah.
education.
So
most
the
of
the
time.
timelines that you mentioned is when do I need to start getting ready for
When,
Medicare?
once you are eligible to for Medicare, you have only a frame of 7 months. The month you turn in the 65, 3 months before and 3 months after. So it's 7 months. After the 7 months, if you are not enrolled, you will get a penalty. So
Okay.
it's very important to get into the Medicare in those 7 months.
Okay, what happened if I am 68, right? Not me. Well, the person has 68, and they never enrolled.
Okay. If you never enroll and you're 68 years old, you go to the Social Security and they will say, "Oh, okay, you didn't enroll in Part B. You are going to face 10% for every year that you haven't enrolled." And also for Part D is the prescription, 1% for every month that you haven't enrolled. So you have to add those
So at the end of the day, it's very important for them to enroll and actually make plans to do that. The reason why is because you're also saving money there.
Yeah.
Not only that, trust me, nobody wants to pay a penalty of just something that you have to do, right? When it comes to health insurance, also, when you don't have health insurance, you're also paying more taxes. That is also very true. So now that we got health insurance, Medicare, life insurance, now I want to ask Ryan, what is an IUL? We touch bases on whole life. We touch bases on just term life, right? But what is an IUL?
Yeah, so an IUL stands for Index Universal Life. Essentially, it's a form of permanent life insurance, so it's permanent. It doesn't expire. It lasts your whole life. And the part that's the index part is kind of goes into a history a little bit. So, so traditionally with permanent life insurance, it started back then 100 years ago as whole life insurance, right? So the whole life insurance, the way how it grows is it based off the company's basically their profit, right? And if they have profit, they pays out a dividend. So the dividend goes into grow the policy. And then there's universal life insurance that existed when interest rates were very high, right, in the 80s and 90s. But then the interest rate came down and the market did really well. So the variable universal life came out after that, go based off the market. But then during the year 2000, 2001, 2002, and 2008, markets started crashing. So the VUL policy started crashing as well. So then they figure out the IULs, right? Because think of it like iPhone, for example. Like every generation, iPhone gets better and better, right? The traditional phone, you can usually just call and text, and now you can take pictures, and all of a sudden now you can serve the web, send email. So the insurance industry get really smart. So over time, they kind of look at what the needs are for the consumer. They start revolutionizing and make products more efficient for today's world. So the index is essentially saying, hey, a portion of the premium is going to paying the cost of insurance, of course, but there's a portion of the premium that's going to a savings component within the policy. And the way how it grows is going to grow in a tax-free basis, and you can have access to the cash value as well. And it's based off of the investment index. Now, the way how this works is really the carrier is still a general account product, but the carrier has the leverage. They can play options. They can do put option, call options in the marketplaces where a portion of client's dollar is kind of going there to grow the policy. And therefore, in case, right, if the market does have a down year, right, the client doesn't have a risk in terms of like the market risk where actually their value goes down with the market. But when the market is doing well like this the past 2 years, the client also get to participate the market growth as well. So it's kind of taking the best of both worlds between whole life, universal life, and kind of take the risk off the variable universal life and then turn into an index universal life, in a sense. Now, with a lot of IULs nowadays too, I would add to kind of Gilbert's point earlier. Hey, why would a young person that doesn't have a need will need to get a form of life insurance? Well, you might not need maybe just a term insurance because you have a big family, you have mortgages, you have kids to feed, and you're married, have a spouse, a responsibility. But what the IUL essentially is, it's a savings program, right? It's a savings program. You're guaranteed not to lose any money, and also it's very tax favorite, right? You don't have to worry about when the money's growing, you have to pay taxes. You don't have to worry about when the money, you can access them. You don't pay your taxes. You don't pay penalties via policy loans, which is great. It's a great idea. And most of the IULs now comes with what we so-called the living benefits, right? So before, people think, the money only pays out if the insurer were to pass away. Well, now it's just in case, right, the client or the insurer has some type of cancers, heart attack, stroke, any terminal illnesses, chronic illnesses, critical illnesses, you can actually make a claim to your IULs while you're alive, right? So we call that the life insurance for the living is no longer just death insurance. And the biggest thing now that we see, especially over the last 11 years, maybe it's the food, maybe it's the water, maybe it's the environment, maybe it's the stress of human beings today. A lot of the disease and cancers start happening to people who are in their 30s, 40s, and even 20s. We even seen the case scenario where a child after 1 year old was diagnosed with type 1 diabetic. And in that situation, for that baby, it's going to be really hard for him or her to get life insurance going forward. So we actually had a dad that took out a policy, because you can technically get an IUL policy when your children or your child's only 15 days old, right? As long as they have a social security number, we can get them a juvenile index universal life policy to start saving for them, to at least lock in their health and lock in their insurability on some basis. So we had a client, John, he put together $1 million IUL for his newborn son X. And at the time, the wife Christine was like, "You're crazy. Why would you put $7,000 a year into a child's life insurance, our baby son's life insurance?" Oh, well, guess what? John's actually also a financial advisor, so he understands how this stuff works. But Christine doesn't understand. But when baby X was diagnosed with the type 1 diabetic, when they're at the hospital, Christine turned to John and said, "I'm so glad that you put that policy together, because our son will likely not able to get policies in the future." So there's a lot of things that IUL that can essentially, I would say, it's kind of the Swiss Army knife in a financial program, a financial tool. It can serve many different purposes, and it serves a really good foundation as far as portfolio and investment diversification. So imagine if you're investing money, which our clients, we encourage them to invest money to buy stocks, to buy real estate. So all those things still needs to happen. But again, the market's a roller coaster. It goes up, it goes down. But imagine you have a policy, a account that only moves in a positive forward momentum at all times. Well, guess what? If the market is down, well, I have this bucket of money on the sideline. I can actually withdraw it and borrow it from the policy and put it in the market to do what? Buy low and sell high. And once you gain the reward, you can put the amount that you borrow back, right?
Exactly. And
So-
that's something I want to touch bases on, because we were talking about last time about what is the difference between a 401k and an IUL. What are the benefits of each, right? And I think you touched bases on it yesterday when it comes to like, because in the past, like you would hear me say like, "Oh, I really don't recommend 401ks, right? Because of this." But if the company you're in with matches you or give you a little bit more, then by all means, right?
Yep.
And you touched bases on it yesterday, and we were laughing on the conference, because I turned to Gilbert and I was like,
I told you.
because people will question me like, "Okay, you don't recommend it, but you have one."
Mm-hmm.
There's reasons why,
Yep.
right? It's what you call yesterday free money.
Exactly.
Right. And trust me, that I mean, it happens to me, right? That 401k came in handy, and you can do a lot more things with it if you invest it right.
Yep.
I think IULs is a very good. I think it's a very good investment program, not only for the investment, but also as an insurance, and also the way you manage it also makes a lot of difference. And I think Gilbert also mentioned that as well, that it's something that you would advise to younger people to get, right?
Absolutely.
So you have any questions on IUL? Because I know you wanted to touch bases on the younger generation.
No, if anything, 'cause you already explained the IUL, right, and how it works. But
But does it sound attractive to you?
oh yeah, for sure. Yeah, I want to say for sure it does, because one, as a young person, you get to grow your money in a way that nobody really teaches you how to do. Because, for example, like in the Hispanic community, like we're not really educated on any of this, like at all. Like if you ask me to ask my parents what that is, like they have no idea what that is.
Right.
So I do think it's like really important for us to get this information out there, because realistically we're not even aware it exists.
Yeah.
And whenever we do like hear about it, we think like, oh, it's a scam. It sounds way
Yeah.
too good to be true.
Mm.
So that's my only, like, I guess.
Yeah. So I would add to, like, so for example, a lot of times people will say, well, is a 401k better, or is an IUL better, or is an IRA better? I explained to them, and look, these are all just financial tools
Yeah.
that you can use to grow your finance, grow your money, to protect yourself, to put together a financial plan for yourself. It's like almost like saying, you know, in a toolbox, is a wrench better than a screwdriver? Is a screwdriver better than a flathead? Well, no, they all have each individual job that they can do. Financial planning is the same thing, right? It all goes hand in hand together. Supplement by Medicare, supplement my health insurance, supplement my accidental policy. 401k is great because guess what? Like, let's say 401k, what it is an employer sponsored retirement plan, right? You contribute your portion, and if your company, if you work like for Starbucks or an Apple or Amazon, they offer employee match. That's what we so-called the free money, right? The two best money that everybody can have is number one, free money. We don't want to leave that on the table. Go get it if you're eligible for it. Number two is tax-free money. So that's kind of where the IUL comes in. So both have a place. Now, 401k, essentially you're deferring paying taxes later, right? It will let you defer all the way till 59 and a half. When you start, well, defer until you take the money out essentially, but technically you have to wait till 59 and a half. So that's kind of the rules. Okay, well, if it's a 401k, I understand that it's a 59 and a half after money. It's for long term. And when I started taking money out of it, I will have to pay taxes then, right? Every dollar, 100% taxable. Now, if I have an IUL, let's say I got it in my 30s, well, guess what? At the 40s and 50s and before 60, 59 and a half, there might be a situation I need money for something. Maybe there's an investment opportunity. Maybe there's an emergency. Well, I could access that money without having to pay the 401k early withdrawal 10% penalty and the tax on top of that. So again, it's just you're maneuvering money and you set yourself up for, hey, I have different buckets of money for different purposes.
So you mentioned something very important that before we move on to that, right? Let me ask you this. You mentioned also like the uncertainties of the market, right? How safe is the IUL compared to the 401k? Because that's something I kind of like.
Well, 401k, you're completely exposed to the market. And of course, typically in a 401k situation with an employer, look, they're not trying to get all fancy because 401k to manage it has a cost, right?
Yeah.
So typically your employer are not trying to give you like the best deal. So typically you have maybe 30 to 40 options that you can choose from, right? So now if you leave your job, we can roll that over to an IRA. Now you go from more of a restricted platform of a 30 to 40 option investment you can choose from to an open platform. Now you can invest in pretty much anything, but you're still in the market. So the IUL kind of comes in and say, hey, look, we always has a principal guarantee, always have a floor protection, either 0%. Some company offer up to like 1% or more on the floor. That means if the market is going down in negative territory, you're still gonna get a positive interest in your IUL. Now, if the market is doing really, really great, let's say the S&P 500, we use that as a benchmark. All the IUL policies, they use S&P 500 index, right? So let's just say if the S&P grows 15%, well, you'll likely be able to participate or have a cap of a 12%, for example. Well, that's not bad, right? If you have if you have a scenario of an account where the market's doing well at 10, 12, 15 or above, and you're capturing 12%, but if the market is down and negative, you don't lose money. I will take that account. I will have that account. I'll have money there all day long for sure.
Yeah, and that's one of the things that I wanted to make emphasis on. An IULs, whenever the stock market goes down, you're flat. You pretty much don't lose, right? So that's kind of like
you lock in the gains.
Exactly. So it is 100% less risky than a 401k.
Yeah,
it's 100% less risky. You have a question, right?
No, not a question, but I want to keep adding to that pretty much on how, I guess if you have a 401k that doesn't come with you compared to an IUL where you always have it. Because 401ks are pretty much given to you while you're at work.
Employed. Yeah.
Employed pretty much. And IULs is basically the same thing in a way, but it's always with you. And obviously it's safer, more benefits.
Yeah. And I believe that, and actually that happens to me. You can leave the 401k in the company, but this is very important for the people to know that if you leave it in the company, there's fees and there's a lot of things that they're charging you, but you're not getting paid from them anymore. Yeah. So it's going to be a lot more like expensive to you to keep it with them.
Yeah.
There's other ways that you can explain later on today about rolling it over into an IRA.
Yeah.
we're gonna talk a little bit about the pensions that you were mentioning before that, 'cause that blew my mind. But in reality is there is options, right? And a lot of people just cash it out, which is practically losing 20 to 30% of your money. And you were explaining that right now, that is not only the taxes that you pay, it's also income. It's considered income after the IRS. And also you're gonna pay an extra 10% you mentioned. So it is very important for people to know what options do I have when it comes to like, I left this company. What are my options with that 401k? IUL it's a very good option, right? But now we're gonna get into that topic when it comes to like, what are my options whenever I have, I don't know, $10,000-$20,000, and then I have a 401k that I have in this company. What can you tell us about the options when it comes to that?
As far as the having money elsewhere,
Mhm.
well, a lot of people, they say if they want to have some sort of now you have to segment your money. So I always say I work in a sequence of threes. So you always have short-term money, mid-term money, and you have long-term money. So short-term or something that is between 0 to 2 years. Like for example, if someone and say, "Hey Karen, I'm gonna buy a house in the next 6 months." Oh well, I know that for a fact that's a short-term money. It needs to be liquid. They need to have access to it. Now, if it's anywhere between midterm, we call that maybe between 3 to 10 years. That usually belongs in a real estate scenario or a brokerage account, or like, for example, life insurance, like IUL. And in the 10 plus years money, they could be the 401ks, could be the IRAs, and could be the annuity. It also could be the IUL as well, because a lot of people, they use the index universal life as a form of tax-free retirement, right? They keep putting the money in, they're healthy, then they may make a claim, they don't have premature death, and all of a sudden at 65, right, they say they put in $100,000 into an IUL, now they have $250,000 in the cash value. Now they can use that $250,000 and active as a tax-free retirement for them to start taking a portion of that money out, like $20,000, $30,000 a year for the next 20 years using the cash value. The other ones, essentially, if people say, okay, well, I just have money sitting somewhere, whether it's from an old retirement account or the money sitting inside the CD, for example, a lot of Asian clients of mine, they have a lot of money in CDs,
Yeah.
which, and other race as well, they just, hey, I'm just going to put it here. It's safe. And I don't want to lose this portion of my money. I say, well, how much interest are you getting in the CDs? Right.
Minimum.
Not much, right? And also at the same time, you have to pay a 1099 on the interest you earn every single year. What if I can show you where we can, if this the money that you only need currently, if we can put that into a plan, right, give you a bonus, let's say it's 24%, 35%, or 55% bonus on the money. So if you put 100,000, and if it's 35% bonus, now your account starts at 135,000 issue, gives you a higher interest rate, right, compared to the banks. And then in the future, this account is gonna help you generate a guaranteed lifetime income, like a pension, that you simply cannot outlive. Would you like something like that? We'll look over some options like that, because most people, they don't have something set up that can do those things. And the only people who have pension nowadays is teachers and firefighters and police officers, mostly federal employees. Back then, our grandparents had pension, but that's going away, right?
Yeah.
So I always ask my clients, hey, would a guaranteed lifetime income help you to make retirement at least more predictable versus all the other accounts just kind of move through the market? So like in 2008, for example, a lot of people say, oh, I have a 401k and I have $1 million and I was planning on retiring this year. But of course, the financial crisis happened, and now their 401k turns into a 201k, right? So if they have a pension program or maybe an IUL, they don't have to worry about those dollars being depleted just because the market had a temporarily corrections or setback. They can continue to move forward in that sense and wait till the 401k in the market to recover.
Yeah, and actually, like, because we were talking about the products that actually the bonus went up and all that stuff right now, and me and Karen, we were like, just looking through it, like, okay, well, we were actually, because I have a couple, and then I was telling you, like, I might change my product to this product, because we own products like that. We're agents, we're supposed to, And actually, like, we see the benefit of it, right? But you mentioned the bonuses, right? What type of bonuses are?
Yeah.
Because I mean, let's say we have $500,000 in an account sitting down in an annuity, because how can we manage that and get to those bonuses?
Yeah, so essentially, if you let's say you have a lump sum of money, and you want to move that into an annuity, you can kind of choose, depends on your situation based off your age and your goals. Now there's annuities and these pension plans that's good for growth if you're younger, and there's some for income. Let's say you're maybe in the 60, 65 that you really need these retirement pension income. There's different product to choose from, and the type of bonuses are essentially there's going to be a premium bonus. So those were the ones that actually gets added. Let's say you have $100,000 moved over, and the premium bonus is 24%. Now, so that extra $24,000 actually goes into the account. It's true, you can walk away with it, right? But there's also a bonus more so for income. So, for example, the income-based bonus, once the money goes over there and the bonus gets applied, that's going to be where the insurance company in the future determine how much retirement income you get every single year, right? So if that's very important, because sometimes, like you say, there's a bonus, but there's different types of bonus, and they're applied in different categories inside the contract. But more importantly, I would say for people that were very interested, especially now, the federal government really helped us out as far as our industry, because we work with life insurance carriers, right? And life insurance carrier, they're among the safest financial institutions on the planet. They do require heavy cash savings and have cash positions, and they invest mostly in safe assets like bonds and real estate and borrow money, and for example. So these interest rates, because interest rates really high, so yes, it's kind of not as good for buying real estate or borrowing money for corporations, but for the insurance products and these contracts for IULs and annuity, they're able to give high interest. They're able to give out these high bonuses because they're making really good money on their safe asset and that they're safe investment. So right now it's a good time for a lot of people to say, hey, does it make sense for me to take a portion of my retirement or a portion of my savings to maximize and enhance and get more benefits from those dollars compared to my current situation?
Yeah, and that's a very interesting way to put it, right? Also, like another thing that I was going to ask you, like we were talking about, nowadays a lot of people have those uncertainties about the market, right? There you see a lot of corrections, you see a lot of things going on, and of course the market is always going to be the market. Corrections are going to be out there, right? But is this a safest way to kind of protect your money, not to lose, in a way that is okay? Well, we know there's corrections, but in an annuity, does it manages the same way as an IUL where your money is safe?
Yeah, so we mostly are looking at fixed index annuities. So similar to index universal life, we use the index strategy. Again, the insurance company is a general account product, but they're able to have portion of their clients' money into options and the options play in the options field, so they can participate as the markets are increasing and having a growth. But again, they are able to have a floor protection, lock in the gains, right, from all the previous year if the market does go into a negative category. Now, as a financial advisor, we kind of understand that, hey, if you look at a scheme of 10 years, a decade, usually 7 years of the decade, the market is positive because we kind of studied it, right? And then, but usually there's at least a 3-year downtrend, right? It just it has to happen, right? You know how when you ride a roller coaster, it can't just keep going up and up and up and up. It kind of has to come down, twist sideways, put upside down. So that's kind of the market, So in the way that, like you said, market is always going to be the market. Now, the annuities, the IUL, is definitely a way to essentially say, hey, let's segment a portion of our dollar to make sure, hey, we're principal guarantee. We never lose a dime if the market does shift, and we lock in the gains every year as the market are positive. And for me, it's the same thing as like if you imagine a vehicle, right? You have gas and you have brake. You can't just have all gas, no brake, or only brake and no gas. No. Doesn't work that way. So, but we can press gas and we can press brake based off the situation when you're on the road. So with an annuity, I say, well, hey, you can defer it and then take out income whenever you're ready. It's going to keep growing for you, kind of like a turkey baked in the oven, right?
Yeah.
And then to the market. So let's say if the market is down, would you take money out of the account? Well, probably not. If ideally, no, because now you're down. And if you take money out, you might have to pay capital gains if the overall investments actually made money. So it's double negative.
Exactly.
So in that situation, I say, hey, look, I'm not going to take the money from the market. I'm going to let it recover because the market will recover just based off time. So in that way, if I have the IUL and I have the annuity money, then good. I can still live, I can still survive and wait till my investments, my risk dollars to recover.
Yeah, and then like today we were like, and I know we're laughing because we were actually like looking at that information and going through the products and all that stuff because that's pretty much what we do, right? But one of the things that you mentioned earlier today is like depends on the goals of each person's, right? You mentioned that one is income based, the other one is towards the debt benefit, right? Who can benefit more? Like, because you also mentioned that it's kind of like a pension based program, right? Who can benefit more from these depends on their goals is, let's say, senior citizens, right? You will recommend them to go after simple, I want to say income based or debt benefit.
So if they're looking still for income, we're gonna go with the income product. Now, there's a certain annuities and pension plans out there that the client utilize in the senior market that basically say, hey, look, I like to leave some money behind. I am not young enough and I'm also not as healthy enough to qualify for life insurance. Or they try, but they're declined, right? Because they're just a scenario where you're just uninsurable, right? Which goes to another reminder, hey, like get your life insurance early at some basis, because your health does change. Now in the senior market, because these bonuses are very high currently, right? There's ways that you can shift some of the cash, some of the money in the retirement account into these annuity pension plan, get the bonuses, and you can actually use the annuity to act as a form of a death benefit. It's still an insurance contract. You can use it via income for yourself to live off your retirement, or you don't have to exercise income. You can use an annuity as a form of a legacy and death benefit strictly for the beneficiary.
Okay. So, and that's something that we were looking into today, like for Gilbert, that he was actually asking, like, what is the best thing for me, right? You're 21, right? Person like me and Karen, like 20, 19 years old.
25.
20. So it varies, depends on the age of the people and their goals, right? So based on the annuities and everything else that we have here, right? Annuities are fixed. They're not variable, right?
They can be variable, but we don't want to do that.
Yeah.
Not here.
Yeah, because a lot of people out there, they see annuities and then they're used to those variable products from the
a lot.
past. Even in insurance, like even in life insurance.
Variable universal life, yeah.
Yeah, we still go out there. And we were talking that day during dinner that we still see those policies from other companies that they were like for $15,000, you're paying $20, but it's only $15,000, right? It's not enough. With this product, not only you can actually gain a lot more, not just from the bonuses, right, but from the market gains, pretty much. Also on the IUL side, I think is more of an investment account with a lot of benefits, pretty much.
Yeah.
Right. So basically, we were talking about people that don't work for a company or they're self-employed for a 1099. We were talking about realtors and all those. You recommend an annuity for them. You recommend that certain product.
Yeah, so I mean, if you're a self-employed and you have a business, so a lot of times we recommend the SEP IRAs for these realtors and lenders, financial professionals, the people who receive 1099, has a business, because again, they can defer more money compared to kind of the regular, IRA, right? Which is like $7,500 versus in a self-employment pension, like the SEP, you can actually defer, $72,000 or up to $72,000 or 25% of your net income for your business.
So that's useful for taxes as well.
Yeah, so you get the tax defer. So essentially, you get the tax deductions on the front end, and then when you put that money into the annuity that's giving out a pension, that give you another boost for the money you're deferring. Got the deductions already. Put the money in for your saving to create a self pension for you, like self-employment pension for yourself. And then essentially, the biggest problem for a lot of realtors, a lot of successful professionals is, yes, their business is thriving, yes, they're making money, but they don't have ways to save money for retirement. And a lot of times, I'll always say this, doesn't matter, it could be a doctor, you could be a professional, a business owner, do you always make money? Does the money always increase every year, or do you maybe have a down year, or maybe something personal might happen? So you need to set yourself up for these scenario that's going to happen, right? So it's like, hey, okay, I don't really have anybody who's forcing me to save money. So a lot of time, business owner, we put most of our money back to the business, which is not a bad idea because we think it's going to get the most return, right? So I'm not saying put every single thing in these financial vehicle, but I would say you should probably have a portion of these dollars to set up to pay yourself first, because in the future you will need it, right?
Yes.
When you stop working, when you were slowing down, well, the second employer kicks in, which is your nest egg, is the money that you saved. So how are they positioned, how they're paying you is the questions we need to figure that out for a lot of the professionals.
Yeah, and I think it's a great product for most people, right? But there's different options and goals. And basically that it's a lot of people ask you, or they ask like financial professionals and everything, right? Is what is the best way to structure my financials, right? And a lot of people don't believe it, right? When I say, like, you know what, first of all, you build like an oxygen line, when I want to say that's untouchable. That's kind of like the advice I give everyone. Because a lot of people ask me, like, how can I invest? Like, if you don't have your financials right, there's no way you're going to try to invest. Because you got to get those financials right first. Especially when you have a job, you have income. For me, it was more important to set up like I want to say, like, I call it an oxygen line, which is something that is not touchable, up to 6 months of my income to a year.
Yeah.
Right. Something happened, there's no income coming or whatever, you can live up to 6 months or a year. And then from there, you can move and say, you know what, all this, right? And also health insurance, that's basic pretty much. Then life insurance. And then if you have the option to do, I want to say, something for your kids and something for your family and everything else. So if it's doable, do it, right? It goes back to the same things that we were talking, is making the right decisions with your money, right? Yep. And the way you want to structure your financials. We spend a lot more money into the new iPhone, the new products that are on the market, the new trends, a new bag, a new watch, right? But the financial decision at home, it's never in consideration to anybody, right? I think for the most part, insurance as it is, and the financial tools that we have nowadays are amazing compared to the ones we had before. And as you mentioned earlier, is nowadays we have the options of annuities as part of making it like a pension-based kind of program, which nowadays pretty much nobody knows that. Like we didn't know that.
Yeah.
So I think most of the information that you gave us throughout these 2 days, it's amazing. Yeah. Thank you for that, and thank you for the information and everything else. But what would be your advice, like step by step, when it comes to like structuring your financials as a person or as an individual?
So back to the building the house theory, right? So make sure the foundation, make sure the risk management is being taken care of based on your current age. So if I'm in my 20s and 30s, what could be the biggest risk for me to where it's going to interrupt and disrupt my entire future, my growth, my goals, my wishes? Well, I could potentially get in an accident. I could potentially get ill, right? So I want to make sure there's a plan in place for that. If I'm in my 30s and 40s where I'm kind of established, I'm making money, am I making sure that I am contributing to a company 401k that's offering me a match, right? But I also need to be paying attention to the taxation of where all my money is, because it's not just the growth of the money, it's also how you're going to be taxed in the future.
Yeah.
We talk about it's not about what you make, it's about how much you get to keep. That's a lot of times there.
Yeah.
And then once you get to your 50s and 60s, ideally in your 50s and 60s, those 10 years are your highest earning year, right? You are experienced in your career or you're established in your business. Well, those are the time where, let's say children might be in college, or maybe they're just out of the house, out of your payroll, what's that I call it. You need to be more aggressive as far as like, hey, how do I set up essentially after 60, 65, the next 25 and 30 years? Because nowadays the biggest risk in retirement is longevity. People are living longer and people are running out of money. And also, do I have a plan in case of, for example, if I need a care, if I need long-term care? What if I get kind of sick and if I can move as well or something happen in retirement, do I have a plan for that? Right? A lot of times these plans are their children. Like they don't have a plan. And so their children becoming a plan, right? Which is terrible. And so when you think of short term and midterm and long term, that's kind of think about life and all the risk that could be involved. When you segment your money, it's also the same thing. It's short term, it's a midterm, it's a long term bucket. It's all bucket of money that I could use for different purposes. And just keep in mind how you're managing your finances, how you're managing your money, and the things you set up directly impacts your children. They're going to learn from your money habits. The things that you do, you'll be able to educate them, right? You cannot tell your children to save money when every month you have nothing left to save, right? Are you a spender or are you a saver, right? A spender is they spend everything first in a month, and then at the end of the month have nothing left to save. The saver is, hey, I'm gonna pay myself first, put some money aside, and I'm gonna spend the rest. So you kind of have to choose the habit, which one you're going to be at. If you're consistently a spender, well, you probably want to make different decisions and to say, hey, look, I'm going to live a while, and I want to make sure I not only set myself up, but I want to make sure my children is also being set up as well. A lot of this, life insurance program and IULs and annuity essentially is setting up the next generation for them to have generational wealth. A lot of, for example, my grandparents, they have no plans, right? They're the money under the mattress. So a lot of times when things happen, when they get sick, both of them went on long-term care, and you see the stress of, like, my parents are both super stressed out when both my grandparents went into care. So I remember like when my dad passed away 6 years ago due to cancer. After he passed away, I found out that more than 50% of his monthly earning was going towards my grandparents' care. So of course he's stressed out. Of course he's really stretched, and those that cause stress, cause sickness, and everything. So it's actually in the book. Like when we're learning financial planning, is the people who are giving care, they're stressed emotionally, they're stressed financially, and oftentimes they're the one that end up going down, which is exactly what happened to my dad. So I will really encourage you to say, hey, look, when people are teaching financial literacy, financial education, obviously gonna see what they're talking about, like learn from them. Not everybody gives great advice, so I would put that out as well. But seek into information and kind of filter it, right? If you're getting the same message over and over again, that's probably right. It's probably that's a general good idea. But again, money is a habit similar to health, working out, and exercise.
Yeah. And I mean, and going back to that is like the habits that you have, and you learn it from parents. Hats off to my parents, because they were pretty, I want to say pretty smart about, like, they already have, I don't know, pretty much all their funeral, their burial, and everything else ready and all that stuff, and they put everything aside, and it's very, like, we don't have stress when it comes to that, right? And I learned a lot from them as we were living, right? But honestly, like nowadays, there is, like, especially here in Laredo, and I want to say the border, right? You see a lot of the people, like, making GoFundMe's and all that stuff, plate sales and all that stuff, and it's kind of crazy that you can actually become a little bit more educated or more structured when it comes to putting something aside on a plan instead of going through those things, right? Because emergencies happen. And today, actually, like Karen, I don't know if you want to talk about it, but she was asking you about like setting up all like products like this and all that stuff. Because I've seen her; she's done. I think you have an IUL now, and products like that. I think she's doing a great job doing that for her daughter as well.
Mm-hmm.
But I don't know if you want to talk about the IUL and also the annuity that you were asking today.
Me?
You were asking about the annuities today.
Oh,
what
yeah,
was the
but
reason you were asking to begin with?
No, for me, like, I mean, yeah, the thing is that most of the time we don't have all the information. So, like now that we know that all the product that we have, we can like make better decisions with our financial future.
Yeah, you wanted to talk about also like about the senior citizens, about the hospice.
Oh, yeah. It's because pretty much it just randomly popped up into my head earlier. How we have hospice businesses. I don't know, for people that don't know what hospice is. It's pretty much a group of people that's pretty much dedicated of taking care of like the elderly who are pretty much on their final stages. And
I mean, a couple of things, right? In that final stages, what often families are talking about is, okay, what are we going to do as far as the funeral arrangement?
yeah,
And also, how do we go about inheritance,
yeah,
right?
yeah. There you go.
So as far as, well, first is like, we know somebody's about to write a check pretty soon.
Yeah.
So is there any plan in place that's going to make sure, hey, at least not paying full price, maybe they can get a discount through some type of financial program, right? Let's say if they know they have to do a proper burial, basic funeral, it's going to cost them 10 to 15,000. Well, do we have the money for that? And if so, where's that money coming from? And there's an idea if we can make it more efficient, right? To where, instead of putting out the 15,000, we just put maybe 5 or something less. Or maybe we can transfer the cash that you currently have on hand to some other vehicles like annuities or some type of different financial program to enhance it. Would you be open to look for that options? And the also most important thing is, let's say if the person is about to pass and they're in their final stages, do they have all their finances, final wishes, will, their trust, is that all in order? Or is the family about to go to all-out war as soon as that person stops breathing? Because oftentimes, that's what we see. Mm-hmm. The siblings get together, they said their goodbyes, but the next thing they know is they're trying to fight is, hey, there's a bill, someone's going to pay it, who's responsible? And also, hey, like whatever mommy and daddy left, who's going to get it? And if those things were not being put together in the legal documents, those things were not being done or being said or being drafted properly, then the family goes into chaos, right? Siblings becomes enemies. Nasty things often get said. And we want to make sure, hey, these programs out there that one, we can either help them with the final arrangement. That's going to help them, not pay dollar per dollar, but maybe pennies on a dollar. And also we can help them apply a family trust to at least get the things documented and in order so no one's confused, no one's unclear once the person passes away.
Yeah. Yeah, I do want to say that the trust is very important because I don't know, there's a joke, I guess, within the Hispanic community that, like, whenever the grandparent passes away, they're fighting for, like, the piece of land.
Yeah.
I guess we tend to own like a lot of ranches and stuff in Mexico.
Yeah.
So then people end up pretty much like the uncles, the cousins fighting over like, oh no, that's my ranch, or this is my ranch, or like stuff like that. So it is pretty like important to have.
And the reason why we're mentioning this is because we have new products that we offer to the public and then to our citizens, right? One of them is estate planning.
Yeah.
I don't know if you can give us like a little bit more, like a deep dive into it.
Yeah, so I mean, estate planning, it's essentially, if clients does have assets, property, money. It could be even be jewelry and arts and baseball cards. We've seen it all. Like some people just have a rock that's not worth of value, but it's worth. But it's like, for example, there's sentimental value to them, right? So all those things could be put inside the trust and say, hey, I'm gonna use the trust to protect all these assets, and I'm gonna have directions, I'm gonna have instruction to avoid all of these chaos and definitely avoid the state probate, right? Because you don't, in the state of Texas, if you don't have that set up, and then when you pass away, the overall value of your possessions over $75,000 or more, you're gonna enter a state probate court, meaning things are gonna be dragged out. You're gonna pay probate fees, filing fees, just money and time, right? And also family fighting. So that's not what we want. So with our trust program, essentially, we can help clients get the documents ready, right? We can help them make changes, make updates anytime they want to. It's a flat fee program, because a lot of times if you thinking, hey, trust is a good idea, but what's next? People oftentimes gets confused. So let's say maybe they go see an attorney, maybe they'll work with a law firm. That's great. Getting a trust done is always great. Only 17% of the population have a trust. So if you're getting it done through a traditional law firm, that's great. But there are a couple issues, right? Most of the law firm, they give you a paper trust documents. So a lot of times that if you do have to, they say, make updates or make changes, you have to kind of take the book back and, take the documents back, and the attorneys will essentially redo the trust, upgrade the trust, and then charge you their hourly rate, right? That's the traditional way of doing it. We figured out ways to have all the documents, just have clients pay a one-time flat fee and nothing more in the future, and they can have 24/7 access to upgrade, to make changes. They get attorney supports, financial professional support. So, and it's fully digital, right? Because the reason why we can make changes, they can have assets like that, is because it's digital. And in case of an emergency, let's say at a hospital, if the clients are incapacitated, they're in a coma, they can make a decision. That's where these documents come in handy, and these easy accessibility comes in very handy. So we kind of revolutionize how a traditional way of how trust could be done, and making more like a future way of how the trust should be done. That's all.
And I mean, when it comes to price, it's practically, I don't want to say half a price, because honestly, like, what is the flat rate that we charge for that product?
Yeah, so if I were to say that on the channel, I would say, now, typically, if you say going to see a law firm or an attorney, you're gonna get different prices.
Yeah.
Because I tried this before. Before we have this program, I refer my clients to attorneys. So let's say they speak to 2 to 3 different attorneys. Now the client situation is the same, the assets are the same, but these 3 attorneys are charging different prices. So who is better?
Yeah.
Right. So essentially, sometimes you're looking at, a simple getting a trust done. It could be maybe anywhere between 3, 4. I've seen 5,000. I've seen 6,000. But I could safely said that basically our one-time fee, flat fee document, everything's ready to go. It's going to be under 3. Right. It's going to be under 3.
Yeah.
So when a lot of people, when they hear that in our seminars or when we speak to them about our program, they're very surprised. Because we have people that come to our seminars and they say, this is incredible because I have paid over $30,000 towards my trust. And you found out, it's a successful female entrepreneur, got kids, got grandkids, great business. She wants to leave things behind. She wants to do the right thing. But every time she needs to make a changes, the attorneys are there to charge her the hourly fee, the $350 an hour, the $500 an hour. So that's just a reality. So we basically take that away and say, hey, you get the one-time trust documents. Everything will be done for you. And you get unlimited change, unlimited upgrades and changes. And, we have an annual fee for that. But that annual fee for that is less than $100 per year.
Yeah. Yeah, because I think I mentioned it to you, because I mentioned it to my lawyer as well. He was not happy about that. But it's incredible how it is very important to set up those things and have it ready for things. Like, personally, we went through one thing like that. Not as bad as that, right? But it's things were not ready, right? And how expensive it is compared to now the options that we have today, it is very, 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 very cheap compared to what we had to pay. Now, now from after the estate planning, the other product that we carry right now is also debt solution.
Sure.
What can you tell us about debt solution? Because I think most of us were pretty excited to carry that kind of product now.
Yeah.
Because not to mention the debt throughout the U.S. right now is the highest ever. So, what can you tell us about the debt solution right now?
Yeah, I was really excited to have this, the education, and also I'm glad that we had this program, the debt solution, and the partnership with this company called Mediator Debt Solution. Just really, take a step back. When I first started in the financial planning career and business, I think 11 years ago, our country's total debt, national debt average was $16 trillion then.
Yeah.
Now we're at 39 trillion,
Mm-hmm.
which is completely insane. And any one of us, if I ask, hey, raise your hand if you know anybody who have debt, credit card, high interest student loans, high interest personal loan, repossessions, it could be medical debt, so on and so forth. All these debts are out there. So essentially how it works is, so it's a free consultation that we can send our clients to. So whether it's our insurance client, our Medicare clients, our retirement clients, we can give them a consultation with our partner to see if it makes sense. Essentially, they will look at what's your total debt, what type of debt it is, and does it make sense for them to enter the program. So let's say if their total debt is $50,000 and the program does make sense, well, the number one goal is to reduce your overall debt. For example, from 50,000 to 30,000, right? Secondly, is to reduce your monthly payment, right? For example, if they're paying $1,000 a month for all their debt, well, we can probably give them a new payment structure of, for example, like $600 a month. Well, so essentially that's great. So we lower their overall debt, and then also we free up an additional $400 to $500 a month in cash flow, where they would have just paid that to the creditor and continue the negative compound interest.
Mm-hmm.
Now we free up the cash flow. We can take the extra $400 or $500 a month, put into one of our savings program, put it into IUL to get them started with their positive compound interest. So that's what I really like about the program. And really, it's a free consultation. If they feel like the program is not suitable, they will actually tell you, hey, it's not suitable for you. You should probably just stay and do the current path of your debt management. But most of the time, I would say, maybe 7 out of 10, it does make sense.
Makes sense.
Yeah.
Yeah, no, and just to kind of like make it clear to the customers and the people out there is all of our programs, all of our consultations are for free when it comes to life insurance, health insurance, investment accounts, state planning, and also debt solution. It's completely free. There's no charge for that. But great products. Honestly, like I think the training for the company this week was amazing. I think we learned a lot from the programs that we now offer, and I think we all of us we kind of like agree
We are
on
so
like
excited for
we were excited because
too much information too.
it was too much information. I mean, well, not too much,
Not
but it
too
was
much,
a lot.
but it's a lot.
It was a
And,
lot of information all at once.
Yeah,
Yes.
and honestly, like knowing that the bonuses and the benefits for the customers nowadays, it's way higher than before, is just amazing.
Yeah.
So I don't know, Gilbert, you want to add up something before?
No.
No?
Yeah, want to say.
Karen, anything you want to add? Anything you
I
want to ask?
think Ryan explained it everything
Yeah.
like
Really?
really well. So we are so excited. Thank you for all the information. And yes, from now we're going to make better decision and help our clients
Yeah.
to make better decisions.
Absolutely. I think the key is just when there's a lot of information, when there's something is new, I think the biggest takeaway is to be excited and say, hey, these are available to me now. I might not know all of it, but at least I know I have leverage, I have resources, and I have support. So don't think that you have to learn the things this week and start doing it yourself. I'm going to be here more frequently, and also I'm a call away. And again, I think all of us here in the industry, generally, we signed up to do this because we want to help people and we want to help our community. And it all starts with education. It all starts with information just like this. and they can also access it for free, right? Because
Yes.
for 11 years, I refused to charge a fee. There's for a reason, because I feel like it's gonna turn people away, and I never knew who I could help, right? I have clients that have not much money with me. They barely have a small program, but it helps them tremendously. I have clients that gives me some amount of money, 7 figures. I help them in their ways, right? So what we want to do, and what Karen wants to do in Laredo, is let the people know in town that, hey, we have all those things we can offer. And if they have questions, they can always come into the office. They can always give it just a call, and we can give them that free consultation. We can give them that education, so they know that they have somewhere to go to, versus just kind of like, I have this issue, but I don't know what to do, so let me just kick the can down the road. And the problem stays the same. Nothing ever changes, and it's the same status quo. We don't want that, right? Because if all of us can help more people, then that means the community gets better. The community gets stronger, and the next generation becomes better. Like, we need to start understand that it's America, right? It's a land of opportunity. It's the opportunity for growth, for business, but also opportunity for learning. And things are changing every day. If you look at how many tax law is passed per day, if you look at estate law, it's passed every day. If you look at Medicare, health insurance, ACA, all the changes are happening every year.
Every year.
Even for us professional, it's crazy. Imagine for regular citizens.
Even worse.
Even worse. So it's like we have a mission, like, on our shoulder, right? And if this is what we signed up for, then do the job. Because if a fire start, I hope the firefighter will come.
Yeah.
Imagine if they don't come, right? So
Yeah.
sometimes I would see that in financial professionals, like, I already do this or I do that. I don't want to kind of step out of my comfort zone. I'm like, well, it's almost kind of saying, like, the firefighters, like, they're not suiting up right away. They just they wait to see how big the fire is going to be, and then come to you afterwards. No, it's if the fire is happening, they get called, they suit up right away, they jump down to whatever they jump down, get in the car and drive, right? So I think we need to have the similar approach as, the men and women who serves in uniform and serve this country. We need to have the same purpose and the same passion.
Yeah, not for sure. I agree 100% on everything. But, well, thank you for everything, Ryan.
Of course.
It was a pleasure to have you in Laredo. This is a one time in a lifetime. But honestly, like, thank you for the information. Thank you for the visit. I think we enjoy a lot the information here, and we can't wait to kind of like show people what we have in the office, and to support them and help them, right? Visit us also on Laredo Integrity Financial, Karen Insurance, and also Ryan from Alliance / Integrity. And thank you for viewing us.
Thank you.
Thank you.